Should you invest in Bitcoin in 2026? This is probably the most common question beginners ask when they first learn about cryptocurrency. Bitcoin has made some people incredibly wealthy. It's also caused others to lose significant money. The answer isn't simple, and anyone who gives you a definitive yes or no without understanding your situation is probably trying to sell you something. In this video, I'll break down the honest arguments both for and against investing in Bitcoin right now, the risks you need to understand, and how to think about this decision intelligently. Let's dive in. First, let's acknowledge what we can't know. Nobody, and I mean nobody, knows what Bitcoin's price will do tomorrow, next month, or next year. Anyone claiming they can predict Bitcoin's exact price is either lying or delusional. The crypto market is volatile, influenced by countless unpredictable factors and filled with irrational behavior. People who bought Bitcoin at $60,000 in 2021 watched it crash to $16,000 in 2022. People who bought at $3,000 in 2018 saw it reach $69,000 in 2021. Timing matters enormously, and timing is nearly impossible to get right consistently. With that disclaimer out of the way, let's look at the case for investing in Bitcoin. The strongest argument is scarcity, combined with growing demand. There will only ever be 21 million Bitcoin. No government, company, or individual can change this. Meanwhile, awareness and adoption continue growing. More people understand Bitcoin, more institutions hold it, more countries consider it legal tender or explore Bitcoin reserves. If demand increases while supply remains fixed, basic economics suggests price should rise over time. Bitcoin offers protection against inflation and currency debasement. Governments worldwide print money to fund spending, which devalues existing currency. Your savings lose purchasing power when more money is created. Bitcoin can't be inflated. No central bank controls it. No government can print more when politically convenient. For people in countries with unstable currencies or authoritarian governments, Bitcoin provides an escape hatch. Even in stable countries, Bitcoin offers an alternative to trusting central banks and politicians with monetary policy. Institutional adoption has fundamentally changed Bitcoin's landscape. In 2020, companies like MicroStrategy and Tesla added Bitcoin to their balance sheets. In 2024, Bitcoin ETFs launched in the United States, making it trivially easy for traditional investors to gain exposure. Major financial institutions now offer Bitcoin services. This institutional involvement brings legitimacy, liquidity, and upward price pressure that didn't exist in Bitcoin's early days. The narrative has shifted from internet funny money to legitimate alternative asset. Bitcoin's network effects are powerful. It's the most secure, most decentralized, most battle-tested cryptocurrency. It has the largest developer community, the most mining infrastructure, the deepest liquidity. Competitors might offer faster speeds or lower fees, but Bitcoin's first-mover advantage and accumulated trust are nearly impossible to replicate. Network effects create winner-take-most dynamics. The biggest network becomes even more valuable as it grows, making it harder for competitors to displace. Historically, Bitcoin has been an incredible investment for those with long-time horizons. Someone who bought Bitcoin in 2013 and held through multiple boom-bust cycles has seen enormous gains despite stomach-churning volatility. Bitcoin's long-term trend, despite crashes that would destroy most assets, has been upward. Past performance doesn't guarantee future results. But Bitcoin's track record over a decade plus is undeniably impressive. Now let's examine the case against investing in Bitcoin. The biggest concern is volatility. Bitcoin regularly drops 30, 40, 50% or more in short periods. If you invest money you need soon or can't afford to lose, a sudden crash could be financially devastating. Bitcoin is not suitable for short-term savings, emergency funds, or money you'll need within a few years. The psychological toll of watching your investment drop 50% is intense. Most people can't handle it and sell at the worst possible time. Regulatory risk remains significant. Governments could ban Bitcoin, heavily restrict its use, or impose regulations that damage its value proposition. China banned Bitcoin mining and trading. Other countries could follow. Even in friendly jurisdictions, unclear or hostile regulations create uncertainty. The SEC's approach to crypto regulation in the United States has been inconsistent and sometimes contradictory. A major regulatory crackdown could tank prices regardless of Bitcoin's fundamental value. Bitcoin faces competition from thousands of other cryptocurrencies. Ethereum offers smart contracts and hosts entire ecosystems. Newer blockchains promise better technology. Central bank digital currencies could offer government-backed digital money. While Bitcoin has network effects, technology evolves. There's no guarantee Bitcoin remains dominant forever. Investors need to consider whether Bitcoin's first-mover advantage can withstand determined competition from both cryptocurrencies and traditional finance evolving. The environmental criticism, while reduced after Ethereum's transition to proof-of-stake, still applies to Bitcoin. Bitcoin mining consumes significant energy. Critics argue this environmental cost is unjustifiable for what amounts to speculative investment, while defenders counter that much mining uses renewable energy and Bitcoin provides valuable monetary properties. The environmental argument influences public perception and potentially regulatory treatment. Bitcoin has no inherent cash flow. It doesn't pay dividends like stocks. It doesn't generate yield like bonds. Its value depends entirely on someone else willing to pay more for it later. This makes valuation extremely difficult. With stocks, you can analyze earnings, revenue, growth rates. With Bitcoin, you're betting on future adoption and scarcity premium. Some argue this makes Bitcoin pure speculation rather than investment. The risk of loss through user error is real and unforgiving. Lose your private keys, and your Bitcoin is gone forever. Send to the wrong address. It's irretrievable. Get hacked or scammed. There's no bank to call, no insurance to cover losses. You are entirely responsible for security. For people unfamiliar with digital security best practices, this responsibility is daunting and dangerous. So what's the honest answer? Should you invest in Bitcoin in 2026? It depends entirely on your personal situation, risk tolerance, time horizon, and financial goals. Here are questions to ask yourself. Can you afford to lose your entire investment without it affecting your life? Bitcoin is high risk. Only invest money you're genuinely okay losing completely. Do you have a long time horizon? If you might need this money within 2 to 3 years, Bitcoin is probably too volatile. Can you emotionally handle 50% drops without panic selling? Bitcoin will test your conviction repeatedly. Do you have emergency savings and are you free of high-interest debt? Investing in Bitcoin before handling financial basics is backwards. Pay off credit cards. Build an emergency fund. Get your financial house in order first. Have you educated yourself about what Bitcoin actually is? Investing in something you don't understand is gambling, not investing. Do you understand the technology, the economics, the risks? If you decide to invest, follow these principles. Start small. Don't go all in. Maybe allocate 5 to 10% of your investment portfolio to Bitcoin if you're comfortable with high risk. Use dollar cost averaging, investing fixed amounts regularly rather than trying to time the market. This reduces the impact of volatility and removes emotional decision-making. Secure your Bitcoin properly with hardware wallets if holding significant amounts. Plan to hold long-term through volatility rather than trying to trade actively. Diversify. Don't put everything into Bitcoin. Maintain exposure to stocks, bonds, real estate, or other assets. Bitcoin should be a small part of a balanced portfolio, not your entire financial strategy. Ignore price predictions and hype. Focus on understanding the technology and deciding whether you believe in Bitcoin's long-term value proposition. Be prepared for regret either way. If you invest and Bitcoin crashes, you'll regret buying. If you don't invest and Bitcoin moons, you'll regret not buying. Accept that some level of regret is inevitable and make peace with it. Be extremely skeptical of anyone promising guaranteed returns or pressuring you to invest immediately. Legitimate investment advice acknowledges risk and uncertainty. Scammers promise certainty and create false urgency. Never invest based on social media hype, celebrity endorsements, or fear of missing out. These are emotional manipulations that lead to bad decisions. My personal view, and remember, this is just one person's opinion, not financial advice, is that Bitcoin is a legitimate innovation worth understanding. Whether it succeeds long-term is uncertain, but the experiment is fascinating and the potential implications are enormous. For someone with stable finances, emergency savings, diversified investments, and the ability to stomach volatility, allocating a small percentage to Bitcoin seems reasonable. For someone living paycheck to paycheck, drowning in debt, or unable to sleep if their investment drops 30%, Bitcoin is probably not appropriate. Bitcoin in 2026 is very different from Bitcoin in 2013 or even 2020. It's more mature, more established, more integrated into traditional finance. This arguably makes it less risky than during its wild early days, though still far riskier than conventional investments. Whether you choose to invest or not, educating yourself about Bitcoin is worthwhile. It represents a fundamentally new approach to money, and understanding it helps you understand broader changes happening in finance and technology. The decision to invest in Bitcoin should be made carefully, with full awareness of risks, with money you can afford to lose, and with realistic expectations. It's not a get-rich-quick scheme. It's a high-risk, high-potential reward investment in an experimental technology that could revolutionize money or could ultimately fail. Only you can decide if that gamble makes sense for your situation. If you found this analysis helpful, make sure to subscribe. In the next video, I'll explain bull markets versus bear markets in crypto, how to recognize which phase we're in, and how your strategy should change depending on market conditions. Thanks for watching, and I'll see you in the next one.